Investors injected $8.9 billion into the conventional fund business for the week ended Wednesday, May 9th, 2012. My name is Tom Roseen. Thanks for joining us today for Lipper's Fund Flows Insight. You know, this flows came in despite investors learning about some pretty bad news. Actually, we saw, news in the headlines basically pointing out that Greece had their elections and they were having problems forming a coalition government. We saw non-farm payrolls come in lower than expected, around 115. I think investors expected about 165,000. And then we saw that Spain actually had some problems when they turned around and partially nationalized their fourth largest bank. This was concerned that had cast a pall over investors during the week, and performance certainly showed that, but certainly not the net flows. Let's look at our macro breakout to see where the money actually fell out for the week and get a little more greater detail. Equity funds took in a little lower than $100 million this week, so a very low number. Taxable bond funds took in $3.7 billion. Muni bond funds took in about $800 million, and then money market funds saw about $4.4 billion as the first inflow in 11 weeks. So when we take a look at this, we start thinking, wow, I just said that we had some bad news. Well, where money went was in conservative style investments and in some international areas as well. Let's get a focus on each macro group to see where that money went. Let's take a look at equity funds. When we take a look, we saw that about equity funds took in only about $77 million, so really a low number. This is actually after suffering a 3.82% market decline for that 1 week period as well. Domestic equity funds saw about $254 million in outflows, while non-domestic funds saw $331 million in inflows. This has been a trend we've seen for quite some time. It's been kind of on again, off again as international folks have gone towards the international side. And in fact, emerging market equity funds took in $348 million. Not a great deal of money, but certainly positive flows when we might have expected actually some outflows in this area. Equity income funds, surprisingly though, took in money, and maybe not surprising. It's been a trend we've been seeing for quite some time. $236 million in net new money. However, this was the 52nd week that we've seen net new money come into this part of the group. So we know investors are looking for two sides, capital appreciation and also yield. Of course, equity income funds provides that. Now, when we take a look more focused, more detailed at the ETF side of the business, which we've been reporting as on the open-end side of the business up until now, equity funds actually lost $6.5 billion only from ETFs. SPY, that would be the Standard & Poor's 500 index, ETF, we saw $2 billion in outflow, and then in the MSCI Emerging Markets Fund, we saw about $1 billion. That's EEM, $1 billion in outflows as well. So again, investors are quick to pull the trigger on ETFs, a little slower, and maybe a little more planning is taking place on the mutual fund side. Well, let's take a look at where yields are most important fixed income funds. They saw $3.7 billion in net new money come in. This is actually the 21st week in a row that we've actually seen new money come into this part of the group. It's the first week in four, however, that we saw negative returns. It was just a small decline, 0.7% as far as the decline was. But where they saw the money go in was where we've been seeing it, people looking for higher yields in a lower yield environment. Basically, we saw corporate investment grade debt funds taking about $1 billion, flexible portfolio funds taking in about $700 million. But interesting, as investors have become more conservative, they've actually started putting money over the last couple of weeks into Treasury and Treasury related type of securities. So the group Treasuries, the group Treasury mortgage, and the group mortgages all saw net new money come in, and the trend has been higher and stronger than we've seen in the past. This week we saw Treasury and mortgage funds take in about $500 million, but one of the things that we saw that this was the largest inflow that we've seen in that group since November 12th, 2011. So I'm sorry, October 12th, 2011. So it's a trend we're going to keep an eye on. As people are getting conservative, they are going after the Treasury and mortgage and govy type of funds. We have not seen that over the last several weeks, because people were actually looking for higher yield. Now they're looking for safety. Well, speaking of safety, let's move on to muni bond funds. Anytime we see money going towards the Treasury type of funds, we see inflow also increase in muni bond funds. We certainly saw it this week as well. For the seventh consecutive week, they took in money. For the seventh consecutive week, we saw positive returns, about 0.49%. And for the 22nd week in 23, we saw them take in money. They took in about $796 million. National munis actually took in the majority of that money, $689 million. And of course, this is a trend again that we've seen for quite some time after Meredith Whitney, called for the meltdown. People saw some buying opportunities, and now I think they're seeing both safety and tax advantages to being in muni bond funds as well. Let's take a look at money market funds. Money market funds for the first week in 11 saw $4.4 billion of net new money hit their coffers. And how it breaks out is we saw taxable money market funds taking about $5.5 billion of that. Institutional funds accounted for $7.1 billion of it, while we saw retail investors actually pull out about $1.6 billion. On the tax-exempt money market side, we saw outflows about $1.1 billion. So overall, again, we've seen people become very, let's say timid, a little bit more shy of what's going on. We know that the global crisis as far as European debt issues are going on is still an issue. We know that there was recent elections where investors are basically not wanting to, actually have more restrictions put on. People are thinking that they should loosen up some of the lending requirements instead of having austerity packages in there. So we saw, votes against that in both Greece, France, and in Germany. So that's a concern. But on the flip side, we're finally seeing a little bit more glimmer of hope that the Greek government is going to actually form a coalition government. There was kind of a sigh of relief yesterday on Thursday. And also we saw the dip in jobless claims come out on a weekly basis. That looked a little better, and we saw good numbers. But unfortunately, we heard that JPM actually suffered some big losses with one of its trading ends, and actually is reporting a pretty big loss for the quarter, and that's certainly what we're going to keep an eye on as well. So for the next week or two, I would expect that we are going to have this kind of on again, off again soft money coming in, and when it does come in, we'll probably see it going to conservative asset classes, and we'll keep an eye on equity income funds on the equity side to see if that is a trend that will continue on. Well, if you want to do a more deep dive into areas that you are interested in, you can go to lipperusfundflows.com, learn a little bit more about the sectors that you like to watch and what flows happen there. If not, join us next week where one of our analysts will talk about the flows for that week as well. Until next week, my name is Tom Roseen, wishing you the best in your wealth planning and creation.